I don't think much would have to change at all. In fact, I think it's happening. The narrative was, gold got to $5,400 an ounce. That was the peak in this cycle. And it went down. And then people go, well, that's it. Gold was a bubble. It's off the top. It's going down. Get out, etc. And I said, no. I said, yeah, it's going down. I mean, it's down over, kind of 25%. There's no, that just is a fact. But it did not mean any of those other things. It did not mean the end of the bull market or not reaching $10,000, which it will. But let me Lucian, I'll just explain how I arrived at that. It kind of not infuriates me exactly, but it's more the case that people they'll come on podcasts or interviews or whatever, yeah, gold's going to 10,000 or 20,000, whatever, but they don't back it up with anything.
Gold's sharp price correction from record highs has led numerous mainstream market commentators to declare that the precious metals cycle has definitively collapsed. However, historical market data shows that severe consolidations are routine behavior before the next major upward wave. Jim Rickards, a well-known economist, author, and financial commentator, emphasizes that deep cyclical pullbacks do not signal an end to the broader long-term monetary expansion. By applying a proven 50% drawdown formula rooted in historic commodity cycles, the recent steep decline from the $5,400 peak represents a standard mathematical reset rather than a bursting bubble. Having established a firm cyclical bottom around $3,900 an ounce, gold has cleared its correction and is now forecasted to achieve an unprecedented valuation of $10,000 an ounce by 2027. Now, we present the clips from Jim Rickards' interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I don't think much would have to change at all. In fact, I think it's happening. The narrative was, gold got to $5,400 an ounce. That was the peak in this cycle. And it went down. And then people go, well, that's it. Gold was a bubble. It's off the top. It's going down. Get out, etc. And I said, no. I said, yeah, it's going down. I mean, it's down over, kind of 25%. There's no, that just is a fact. But it did not mean any of those other things. It did not mean the end of the bull market or not reaching $10,000, which it will. But let me Lucian, I'll just explain how I arrived at that. It kind of not infuriates me exactly, but it's more the case that people they'll come on podcasts or interviews or whatever, yeah, gold's going to 10,000 or 20,000, whatever. But they don't back it up with anything. Anybody can throw numbers like that out there, but I like to provide the analysis. And this goes back to a conversation I had with Jim Rogers about 10 years ago. It was around 2015, give or take. No, actually, it was before that. It was around 2014. And, Jim, probably know him. He's the world's greatest commodity trader, co-founder of the Quantum Fund with George Soros. Nobody knows more about commodities than he does. And at the time we talked, gold was in a bear market. It had peaked in August 2011 at $1,900 an ounce. It had then fallen to around, when we spoke, around $1,600 an ounce, but it just still felt like it was going down, which it was. And he said to me, look, I own gold. I'm holding on to it. I'm not really changing my views on it. But he said, Jim, no commodity goes to the moon without a 50% drawdown along the way. And if you don't understand that and you can't deal with that, you're in the wrong market. And I said, okay, thank you. And I took that to heart. And then I took his advice and I applied it. And I said, okay, so what was the peak? It was $1,900 an ounce. Now, if you want to do that math, you need a base. It can't be zero. So I took $250 an ounce from 1999. That was the low, the post 1980 low. So I took $250 an ounce as my base, $1,900 as my peak. I took the difference, divided by 2, subtracted it from 1,900, and I got to 1070. Well, guess where gold bottomed? 1050. And again, using Rogers' method, it totally stuck the landing. It bottomed in December 2015 at $1,050 an ounce. But using Rogers' methodology, your forecast would have been $1,070. But I mean, that's kind of irrelevant. You're within like $20. So I was like, wow, he was exactly right. Not surprising because he's Jim Rogers, but I said that works. And what a forecast. And gold's been going up ever since, to $5,400 an ounce. So there's something, in applied mathematics called fractal mathematics and scale invariance. And these ideas were advanced by Benoit Mandelbrot beginning in the 1960s and continuing, but there's nothing new about it, but it's relatively new being as applied to finance. So I said, okay, and just to kind of illustrate scale invariance, if I showed you a 10-year stock chart and I showed you a 10-day stock chart, but I whited out the dates and the index. I just showed, real numbers, real charts, but I just showed you the charts without the metrics. They look the same. Not identical, but, peaks, valleys, rallies, dips, whatever. They look the same. In other words, complex phenomena are scale invariant. They repeat the same pattern at every scale, large and small, short and long in terms of timing. It's the same thing over and over. And that's what scale invariance is. So I said, okay, well, if that's true and it is true, why not take the Rogers methodology, apply it to more recent developments, rely on scale invariance to tell me that it's the same thing over again and see what's going to happen. So a couple of months ago, I did this and you have to pick a base. So I picked, $1,800 an ounce, and gold was $1,800 not that long ago, just a couple of years ago, it was $1,800. I took $5,400 as my peak, which it was. Take the difference, divide by 2, subtract from $5,400, and I got $3,600 an ounce. And I said, this was when gold was still in the high fours. I said, gold's going to go down more and it could bottom at $3,600 an ounce, but that's the bottom and it's going to go up from there, go up a lot. Well, gold did bottom at about $3,900 an ounce. So that's not as close as, Jim Rogers got it in 2015. But candidly, if I just picked a different baseline, I would have got the $3,900 an ounce bottom. That doesn't matter. The method worked, the math worked, the scale invariance worked, and I was very close to picking a bottom based on the 50% drawdown. But I didn't get it exactly right, but I got it right enough to know when I would see it and what would happen next, and that's exactly what happened. The bottom at 3,900 and change. It's now up to 4,500, and it's going to go a lot higher from here. So the drawdown has happened. The 50% drawdown has happened from a higher base. We hit the bottom. We're off to the races, and now so I feel completely confident in the $10,000 an ounce valuation. Who knows? I mean, it won't be a long time, 2027 sometime, but we're now on track for that.
Financial market movements are fundamentally governed by the quantitative principles of fractal mathematics and scale invariance. Originally advanced by Benoit Mandelbrot in the 1960s, scale invariance demonstrates that complex financial phenomena replicate identical structural patterns across all temporal dimensions. When examining a 10-year price chart alongside a 10-day chart with the labels removed, the structural peaks, valleys, rallies, and dips appear virtually indistinguishable. These recurring geometry patterns prove that market behavior repeats self-similar cycles regardless of the specific time frame being evaluated. Applying this quantitative framework allows analysts to decode severe commodity price swings through objective mathematical laws rather than speculative guesswork. Recognizing scale invariance transforms apparent market chaos into recognizable, repetitive structures. Now, let's get back to the interview.
What investors should do is basically don't short the index, but have a portfolio that will be robust when the index pops, when the bubble pops. So is it a bubble? Yes. Will it pop? Yes. Will that be, catastrophic, potentially for a lot of investors? Yes. But you just don't know when. And then, in other discussions, people say, well, Jim, what's the catalyst? What's the thing that's going to pop the bubble? And my answer is, it doesn't matter. And the reason I'm not being glib when I say that, it doesn't matter because it will be something. We don't actually have to know what it is. We might not particularly care what it is. It's just that you can be certain that it will be something and that the collapse will come. Now, it's likely if you said, Jim, could you give me a list? Yeah, Lucian, you could put a list together. I could put a list together. We all know what they are, Strait of Hormuz, war in Iran, war in Ukraine, credit bubble, circular lending. We all know what the list is. It's highly likely that the thing that pops the bubble is something none of us have ever thought of. And that's what happens quite frequently. It's like, and now after the fact, everyone says, oh yeah, I thought of that. But the truth is, it may well be something that none of us would have on our list. But, and that's interesting, but it doesn't matter because it will be something. And that's what does matter. So bubble, yes. Collapse, yes. Catalyst doesn't matter because it'll be something. When? Very hard to say, but probably sooner than later. So that's again, listen, we can drill down on all those issues, but that's kind of a big picture of where the economy, and not just the economy, but capital markets sit today, and how to reconcile, sky high prices with a long list of geopolitical bad news. Even in a world of high inflation, there's strategies you can pursue with cash in terms of whether short-term treasury bills or, bank CDs. Well, in the world we're talking about, bank CDs will pay 10%. They don't now, but they will in that environment. So inflation is not the end of cash if you deploy it in ways that can beat inflation. Those ways are out there. And of course, gold, we know gold performs very well as well. So there are plenty of, I'm not pro-inflation, but it's naive to think inflation is not coming. When you do the math on debt to GDP ratios and annual budget deficits and trends, and you distinguish between nominal GDP and real GDP, you pretty quickly get to the fact that the only solution is inflation. No governments will admit it, and I'm not saying it's tomorrow, but cash has another benefit, Lucian, which is and people don't appreciate this. It has embedded optionality. Mm-hmm. So let's say I said to you, hey, Lucian, I'm going to sell you an at-the-money call on every asset class in the world. What do you think that's worth? And I say, well, that sounds pretty valuable to me. Well, that's what cash is. If you have cash, you have the option to go buy stuff if the price is knocked down enough. And that option is valuable. So that adds to the value of cash. It's kind of invisible. But if you understand option theory and optionality, and that cash gives you an option to buy things at a time when everyone else is selling, you can be the buyer. Yeah. That option has value. So you have to add that to the value of the cash when you think about what it's worth in a portfolio. It just got a little easier because it's happening, which is the unwind of the yen carry trade. Now, for the benefit, this actually I think is the biggest financial story of the world. This is bigger than they're all related because one thing can trigger a next and you get into a cascade, but this is bigger than what we've been discussing so far. So for the benefit of the audience, let me just explain what the yen carry trade is, and then we can kind of talk about the significance of it. It's the backbone of all global finance, but it's a fairly simple idea. So let's say you're a high quality borrower, you're a major corporation or, asset fund of some sort. And, you want to borrow intermediate term for some investment. It could be a hedge fund speculator. It could be a investment bank doing M&A. It could be a private equity firm doing a roll up, a takeover. It could be a lot of things. But you want to borrow and do a deal in US dollars. What is your interest rate going to be? It's going to be around 7%. It's going to be higher than treasury notes. But if you're good credit, not that much higher. I'll say 6 or 7%, somewhere there. That's going to be your cost of funds. What's the cost of funds in Japanese yen? Well, until very recently, it was zero. It was zero. It's been zero or negative for over 30 years. So you say to yourself, well, I'd rather borrow 0 than 7%. How do you do that? Well, but I need dollars because I want to do my deal in dollars. How do you do that? What you do is you borrow in yen. You can borrow from a Japanese bank. It doesn't have to be a Japanese bank. Any bank with a Japanese yen lending facility. You borrow in yen. You pay 0%. You convert the yen to dollars spot, just call a bank or a foreign exchange deal, or you sell the yen, get the dollars, take the dollars, invest it in whatever you want it to do. And now right away, you're saving 7 points, 700 basis points on your cost of financing. And the investments I talked about are leveraged. So a hedge fund is going to be leveraged maybe 3-to-1. Private equity roll-up is going to be leveraged 10-to-1. So at that point, you're not just saving 7 points. You're saving between 21 and 70 points.
Global capital markets currently sit atop an overextended credit bubble, fueled by unprecedented financial leverage. Debating the exact catalyst that will burst this bubble is entirely irrelevant, as structural vulnerabilities ensure that an eventual market reckoning is unavoidable. Amid widespread financial fragility, holding strategic cash provides an overlooked defensive benefit through embedded optionality. Liquid capital essentially acts as an at-the-money call option on every major asset class, empowering investors to step in and acquire undervalued assets when distressed market participants are forced to liquidate. Simultaneously, the global financial system faces severe disruption from the unwinding of the Japanese yen carry trade, long considered the foundational engine of worldwide speculative credit. For decades, major institutions and private equity funds borrowed massive sums in zero-interest yen, converting the funds into dollars to finance highly leveraged corporate takeovers and hedge fund portfolios. As Japanese monetary conditions shift and this multi-trillion-dollar carry trade unwinds, the resulting global liquidity contraction will trigger severe cascading shocks across interconnected financial markets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.